It's time for Q&A with the Credit Game.
Spring Financial started in 2014. They offer a GIC savings loan, or what they call the Foundation Credit Rebuilding Loan. A GIC savings loan is essentially a very expensive forced savings program. You don't get any money from Spring Financial unless you apply for a personal loan, which is a completely different story. The foundation loan is a 12-month commitment, and here is really the sales pitch. After a year of good payments, you are automatically approved for their Evergreen loan, which is a traditional personal loan of $1,500. You would have $750 of savings and a higher score based on your good repayment history. If you try to cancel before the term is completed, you must pay them the fees and interest on the full term out of your own pocket, or you will be sent to collections, which of course will really hurt your credit. It is important to have this concept very clear. The foundation loan does not lend you money. You are essentially paying Spring Financial interest and fees to report the loan to the credit bureau. Confused yet? You are not alone. Instead of rebuilding credit, many Canadians end up hurting their credit score with late payments and collections because they didn't understand it wasn't a real loan in the first place when they signed up. In this video, we have the Spring Foundation Loan Review to see how it really affects your score. There are 4 main categories I look at before recommending credit rebuilding loans, credit cards, or any line of credit. How expensive it is, does it report to both Equifax and TransUnion, the value to the score, or how much it affects the score, and the value to the underwriter. An underwriter works at the bank and reviews your credit application before you get approved. One of the biggest downsides to this product is how expensive it is. The loan amount will report for $750, and it is a 1-year term. You may notice I didn't include any monthly payments. Salespeople are trying to get you to focus on the low monthly payment because it tricks your brain. In my opinion, to make an educated decision, you need to review the contract for the cost of borrowing. The cost of borrowing section is where any lender is forced to outline the total cost of financing. Here's the cost of borrowing for the 12-month term. This is not the number of how much you pay. This is how much it will cost you plus the $750 of savings that you end up at the end of 12 months. Because of how crazy expensive this is, I give the Spring Financial Foundation loan an X for charging stupid high costs on your own money. The Spring Financial loan reports to both Equifax and TransUnion. Not all GIC savings loans do. Just like any other loan, when you pay your bills on time, the Spring Financial Credit Rebuilding Loan will build your credit score a bit. The longer an account is open, the more effect it has to the score. Once you close or pay off your loan, the account is closed and it doesn't help your score very much. If you'd like to learn better or better understand why paying off a loan lowers your score and some other reasons why you might not want to apply for a loan, you can check out these videos in the More Info or Show More section. Underwriters do see loans as credible accounts when trying to rebuild your credit. However, they would much prefer to see them with a major bank. Seeking a loan with a non-major bank could make you look desperate. The underwriter may assume that you're taking out a high-interest, high-fee loan because you can't handle your finances properly. That may not be true, but when it comes to the banks, you are always guilty until proven innocent. That is why I grade the Spring Financial Foundation loan as a low, because most underwriters won't be impressed, regardless if you have made all the payments on time. My biggest problem with the Spring Financial Foundation loan is that it will report you as late and even send you to collections if you don't pay on time. Now, on a typical loan, I get and understand why this is necessary, but on a GIC savings loan, it's your own money. They don't lend you a penny. In my opinion, they should charge you all the fees and interest up front, and then they can allow you to stop payment at any time. This would reduce the risk of having a credit rebuilding loan that hurts your credit instead of helping. I know some Canadians prefer a loan because they don't like credit cards. If that is your situation, I suggest you look at the link of the Coho Credit Rebuilding Review. You can also check out this other video I did that outlines a trick on how to use a credit card to get all the benefits with none of the temptation. If you believe a loan will do wonders for your credit, I suggest using the other credit reporting product types until your credit is good enough to be approved with a major bank. A loan with a major bank brings much more value to improving your credit and is a heck of a lot less expensive. Before signing up with the Spring Financial loan, make sure you review the total borrowing cost to make sure it is worth your money. The More Info or Show More section has all the up-to-date reviews of the different credit rebuilding products offered in Canada. So you could always use that to compare to find which one is better for you.